Hello out there, dividend growth stock enthusiasts. It's Colby, the DGI Crab. In this video, if you like bulk, you like to see a lot of different stocks looked at, we're going to take a look at 40 dividend stocks in this video. I refer to these 40 stocks as the bubble stocks. And why do I do that? Well, simple. It's because my channel is dedicated to focusing on 60 of the highest of quality dividend growth stocks, split into 4 separate categories or tiers based off of the age of the investor. Now, when I was putting that group of 60 together, I had more than 60 to start out with. I had to whittle that list down from around 250 stocks that I had piled together to see which ones were going to make that final cut. When I got down to about 100, it started to get more and more difficult to slash that number down. So these are 61 through 100, more or less, on that list. And don't worry, I've split these 40 stocks into age-appropriate tiers as well. We're going to take a look to see where the value lies. I base my valuation metric on consistently growing dividends year in and year out, long track records of consistency, wide moats if possible, name recognition where you can find it. But overall, I want that dividend growth consistency and safety year over year over year. So let's take a look at the bubble stocks. Now, I base my valuation metric primarily, once I've gotten the quality of the companies figured out, on the current day yield versus the 4-year average yield, and I look to see how far that's off. I don't like to purchase stocks unless they are yielding at least 30% or more above their 4-year average yield. So I got my 4-year average yields up to date on all 40 of these stocks, and I'm going to start in the tier 1 category. So these are stocks that would be most appropriate for an investor aged 18 to 30. I'm not a licensed professional financial advisor. You should do your own due diligence before you invest or make any decisions. But I'm of the opinion that the 18 to 30-year-old investor shouldn't be chasing yield. They're going to be looking at probably lower starting yield for the most part, but they're trying to get very rapid and consistent year-over-year dividend growth. So companies like MasterCard, for example, which offer very low growth historically, or very low yield historically, but very fast dividend growth, this is going to be a really attractive company for those 18 to 30-year-old investors who have a lot of time on their hands to let the dividend increases snowball year over year over year. If you're up in your 50s and you're still trying to reach financial freedom through dividends by acquiring dividend-paying stocks, the 0.6% yield that MasterCard offers isn't going to give you a lot of bang for your buck. You don't have as much time in the market. You maybe don't have those 30 years plus of dividend snowball effect to take place for you. So there's nothing in this little group here of 7 stocks that I would consider a slam dunk buy right now. You might like any of these individual stocks. You might be buying them right now. But I just think that there's going to be better values out there to take into consideration. MasterCard, currently yielding 0.6% when the 4-year average is 0.53%. Not a terrible move to make right now, especially if you are looking for a payment processor. Maybe you've already got a large Visa position, or and you want to start building up something else. You could go with MasterCard. Not overpriced, but not remarkably undervalued as well. Lincoln Electric takes the top position on here. Lincoln Electric, not super exciting. Stock ticker LECO. I don't see a lot of people talking about it. If we look over here on Seeking Alpha and take a look at the dividends tab and the scorecard, you'll see here Lincoln Electric has 23 consecutive years of dividend growth. They have a 5-year growth rate of 8.75%, so a pretty good compounder. And if we look at that growth, we hit the growth tab here, we can see year over year how they've grown those dividends over the past 20 plus years. And you can see we've got 9.5, 13, 11, 20 and 21 were kind of slower years as we were going through the COVID crisis. They slowed their dividend growth down a little bit. Leading up to that, though, 15, 13, 9.9, 10, 21, 18, 16, a lot of double-digit years of dividend growth. A little slower in 2009 during the financial crisis, but you can see they've grown that dividend through a couple of major market corrections, and a lot of the times they're doing it at a double-digit percentage clip. So Lincoln Electric, again, not super underpriced, but probably the most underpriced in the tier ones. For the tier 2, now this is going to be for the age 31 to 41-year-old investor. We're looking for a little bit higher starting dividend yield here. We want to get at least 2%, but hopefully more like 3.5. Still want to get high single-digit dividend growth rate cumulatively out of that group. And what we can see here is a bunch of stocks in this category are in my 30% or more undervalued, headed up by Hewlett Packard, HPQ, 56% off the 4-year average yield. 3.16% average yield, currently yielding almost 5%. HP might be one to take a look at, especially if you don't have a lot of tech in your portfolio. This one is going to be on the hardware side of things as opposed to the software side of things. But certainly, it's a brand that most all of us should recognize, I would think, at this point in time. Comcast is another stock that I think it definitely should be paid close attention to, especially when it dips down here into the low $30 per share range. Their 4-year average yield of 2.64% is much, much lower than what they're yielding right now at 3.91%. $127 billion company by market cap. Might take a quick look at Comcast. And then one of my very favorite stocks that didn't make the list here is this small regional bank, Bank OZK. They've only got a $4.3 billion market cap, but Bank OZK is a really interesting one. So right now, it's yielding 4.53%, currently yielding 3.16%. Let's take a look here at Bank OZK here on Seeking Alpha. I'm going to show you why I like this one so much here, you guys. So if we go to the dividend scorecard here first, we can see that Bank OZK has consecutively grown that dividend for 27 consecutive years. They're not a large enough company by market cap, I don't believe, to be considered a dividend aristocrat. They might be in the S&P 500, but I'd have to double check on that. But they've got that 27-year growth history, so a lot of track record there. If we look at the dividend growth, what they typically do year over year, you're going to see here a lot of double-digit year-over-year dividend increases. They increased this dividend like an absolute beast, including through the 2008-2009 financial crisis when most banks were slashing their dividends. Bank OZK was increasing their dividends. I'm going to show you here on the dividend history, the thing that makes them particularly interesting, if all of that wasn't good enough, is Bank OZK typically increases their dividend every single quarter. So they do small dividend increases every single quarter for the most part. And that is what gives us cumulatively double-digit dividend increases year over year over year. Look at these consecutive dividend increases by quarter. So consistent here, you guys. I mean, we're back at 2015, and we can see every quarter we're seeing dividend increase every quarter, half a penny every quarter. We get up here in 2018, it starts increasing by a penny a quarter. Little bit of a slowdown in 2020, but they didn't break that dividend increase streak on a quarterly basis during the COVID year. 25 to 26 cents, then up to 27, 27 and a quarter, 27 and a half. See, they slowed it down just a little bit, but then they've gotten right back up to 1 cent per quarter dividend increases. I love Bank OZK. This is certainly one of my very favorite stocks that didn't make my overall top 60. Primarily because it's just a smaller regional bank and I wanted to have super blue chip stocks in there. But man, this one performs like a blue chip stock. So take a look at Bank OZK if you want some regional bank exposure right now. I think that they are trading at a massive discount right now. So we go to Bubbles Tier 3. This is for the 42 to 53-year-old investor where we're looking to get starting yield in the high 3%. Low 4s, maybe even better depending on what it is that we're buying. Probably aren't going to get high single-digit dividend increases out of this group, but still we're going to be looking at like 5, 6, 7% year-over-year dividend increases. Right now, out of this group, Prologis, which is a real estate investment trust, one of the biggest ones out there, is still trading at an absolute steal. Real estate uh, man, this has just been a sector that's been hit hard in the higher interest rate environments. I don't know how long we're going to be in higher interest rate environments. The Fed cut those rates a little bit last year. Maybe they're going to cut them a little bit more this year. Maybe they won't. I really don't know. I was wrong in my previous predictions on what I thought the Fed was going to do. So don't go to me for that particular piece of advice. But Prologis, 4-year average yield 2.58%, currently yielding 3.96%, $94 billion by market cap. Prologis is a really interesting one that you may want to take a closer look at. Now, real estate investment trusts are not quite as tax advantageous as qualified dividends that you're going to get with things like energy and consumer staples and utilities and things of that nature, tech. But when you're getting such a great deal on the current day yield, and especially as you get into your late 40s, early 50s, maybe you haven't quite gotten to that point where you've got enough money coming in out of that portfolio to retire comfortably off of, and you're really trying to make that final push. Maybe you don't have much of any real estate in your portfolio at all because you've been going for qualified dividend income. Adding a little bit of real estate at that point in time, not the worst idea in the world. And certainly for any of you that have Roth IRAs, where it's all tax free and the type of dividend it pays out doesn't matter one way or the other, certainly ought to be looking at Prologis as a possible addition to your Roth IRA. And then finally, bubble tier 4, this is for the 54 and older crowd, the ones that really need to focus more on higher starting yield, maybe not as high dividend growth rate. I don't want to throw dividend growth rate completely out. You still want to hopefully get 2, 3, 4% dividend growth year over year so you can keep up with average annual inflation. We've got some intriguing ones here at the top. So Alexandria Real Estate Equities. This is another REIT, more real estate, primarily centered around medical office space. They have really not recovered in share price value since the pandemic. We're going to take a quick look here at ARE just so we can get a better sense of exactly what kind of a dividend performer they are. We're going to go to the scorecard first. 14 consecutive years of annually increasing that dividend. The dividend growth year over year has slowed down a little bit in recent years, but it's been fairly consistent. 2024 was a 4.5% increase. We see some fives in here. 6s, 7s, 8s, 6s, 5s, going back a decade. Really consistent, not super fast growth, but certainly not bad for the real estate space. That's every bit as good as what you'll see out of Realty Income from a dividend growth perspective. Now, to check to see what are the metrics to check on a real estate investment trust to see the safety of their dividend, you're going to want to go to the profitability tab if you're seeking alpha. And you're going to want to check that AFFO payout ratio. This is going to be more important than the standard payout ratio that non-real estate stocks use. They're at 69.99%. Let's just call that 70. That's a great spot to be in for a real estate investment trust. So I think they're going to be able to continue to grow that dividend at the same clip that they've been growing it at for quite a while now, meaning around 5-ish%, give or take. And you're going to get a starting yield right now nearing 7%. So that's a nice combination. Starting yield at 6.78% with a 5% on average dividend growth rate. That's pretty darn good. So take a look at this one. Also, keep an eye on LyondellBasell. I mean, wow. $56 a share for LyondellBasell, yielding almost 9.5%. 4-year average on LyondellBasell is 6.7%. I'm really kind of floored that this one's trading so low. Now, I don't follow all of these as closely as I follow my primary 60. So definitely make sure if any of these look particularly appealing to you that you do a deep dive. I've shown you a couple of things that you can do to take a look at their history and their payout ratio and their dividend payments history. But if the stocks that I talk about each and every week amongst that group of 60 are not your cup of tea right now, You might take a look at some of these. I think there's some good value here as well. Let me know what you think down in the comments. Are there any here that you have in your portfolio that you're currently buying? Till next time.